Another day and another lower move in the 10-year Treasury yield. 3% came, it went, hasn't been back really since. All right, Larry Shover joining us. He's the Chief Investment Officer of SFG Alternatives. Mr. Shover, let's talk bonds as we like to with you, sir. So is this the way you imagine things playing out when you told us that we weren't going to get above 3 very quickly?
Well, the reason I thought that was, like, consider this. You have Powell being hawkish, raising rates 25 basis points, the strongest retail sales number in 6 months, rising GDP estimates all over. You have Draghi also being hawkish, and at the end of QE, and guess what? Yields couldn't climb higher. They fought it. And so with that in mind, that's more surprising than the bull flattening or the 210 curve flattening out. I mean, the fact is how it did it. I mean, this goes against all convention, but it goes to the fact that, once again, the growth and inflation metrics just aren't underneath the market to allow 10-year yields to rise substantially.
So, Larry, there's a healthy debate about this happening, I think, on the Twitter sphere and financial community at large, because there is now a question of not, what the trajectory is or how fast it is. It's really what is causing it. Now, to your point, that's a very macro interpretation of it. I think last week there was a very clear indication that there's a lot of truth to that, right? Because Draghi and the doves outside the Fed basically kept our rates low. But then I could also say, all right, Larry, well, this morning we have all these trade items. Maybe this is just a safety bid. Maybe this market is acting wacky when yields should be higher.
Yeah, I mean, I think there's some credence to that, but the fact is we're only 3 basis points lower, and I think maybe, 4.5 to 5 basis points lower overnight. So I don't think the market takes, like, these trade tensions very seriously in the scheme of things. I mean, I think there's other things going on that's making risk assets appear the way they are. So, I mean, if it was a flight to safety, I think bonds would be, yields would be much lower than they are right now.
So what about that Italian situation as another example, Larry? There was a big push into bonds that day. I mean, a rush that seemed like as close to that kind of safety bid as we've seen in quite some time. We haven't fully recovered since. So is there trepidation that maybe just isn't showing up in VIX, isn't showing up in other risk assets, or what?
It really isn't. That's the amazing thing. It's actually puzzling. You're right, and the VIX is definitely not demonstrating itself. Definitely seeing it in some of the foreign currency crosses, especially when you look at skew, the equidistant out of the money call versus the put. But overall, no, it just seems like, again, it's not so much about trade tirade or TIF or whatever you want to call it, because really the math doesn't work. Whatever Trump is proposing at $400 billion, it does not work. I mean, there's a huge distinction between sales and manufacturing, and I think there's a lot more going underneath the current than the headline risk that we're reading every day.
All right, so Larry, now that we've had this bond conversation, what do you do with that? Because, I like to give you credit, because when everyone was talking about those higher yields, it didn't happen. But then how do you take that sort of insight and then leverage it into actionable sort of trading? Are you looking at yields staying low to push a growth trade in stocks? Are you looking at dollar getting stronger? What's then the next move after you have this understanding of bonds?
Yeah, well, I do think, and I actually hope that 10-year yields don't go lower than 2.5 in the year. I think that would be real trouble, an indication of things that structural changes in the world and in the economy. So I think that the trade to watch is the 210 curve, and I think we're going to see inversion or close to it. We keep hitting cycle lows, and I think that's going to be the trade. The dollar, I do not think is going to continue to rally. I mean, I think it's got some more time, but the fact is we're closer to end of cycle than some of the other countries. And in fact, I'm quite bullish on the euro currency, and I do think we'll see 125 in that by the year end. Right now, the dollar is just overshot like it always does. And I think unless you're an exceptionalist, which I'm not, I just don't think the dollar is going to continue to grind higher like it has.
So Larry, but here's the thing that I have trouble then with, because if we've got the yields remaining low and the bid in bonds sticking there because the story is challenging around the world for other central banks, then won't that divergence just keep pushing the green back up?
You'd think so, but here's the deal. I mean, and I know everybody knows this, but yields to a certain degree are trapped. They have a ceiling with regards to what's going on in other countries, and I think especially the euro, and you have the German Bund. I mean, that needs to rally profusely just to catch up. It's at all cycle wides. And that's why I said earlier that 2.5% seems to be that comfort zone. We get below that, that's going to be really, really hard for our economy because it's going that way for a reason, and that reason's not good. And I just think there's structural changes with overproductivity in our society that's just keeping yields. We're going to be lower for longer, and that's the bottom line. Has nothing to do with the Fed owned. The Fed owns the first 5 years of the curve. Beyond that, it's growth and inflation, and it's just not there.